buying a home in 2026 might be the worst financial decision of your life, unless you know the exit strategy. The mortgage isn't what bankrupts you. It's the two silent assassins. Everyone remembers 2008, the fear, the foreclosures, the fire sale. But if you are waiting for that to happen in 2026, you are going to go broke. Because the housing crisis of 2026 looks nothing like 2008. The mainstream media is screaming crash. The realtors are screaming buy now. But the data, the real math deep inside the Federal Reserve, tells a much scarier story. We aren't heading for a collapse. We are heading for the Great Freeze. And in a freeze, prices don't drop. They suffocate. Today, I'm going to show you the 3 silent indicators that prove why buying a home in 2026 might be the worst financial decision of your life, unless you know the exit strategy. Let's look at the math that Zillow isn't showing you. Right now, 80% of American homeowners are sitting on a mortgage rate below 5%. They are locked in. If they sell their house and buy a new one, their monthly payment doubles. So they aren't selling. This is why inventory is low. But here is where the crash bros get it wrong. The lock-in effect has an expiration date. It's called life. People get divorced, they die, they lose jobs. By early 2026, the life factor forces inventory onto the market. We are already seeing it in Austin and Cape Coral. Inventory is skyrocketing, but buyers still can't afford to buy. This creates the stagflationary housing market. High prices, high rates, zero transactions. It's not a bubble popping. It's a balloon slowly leaking air while you hold it. But looking at the price of the house is your first mistake, because in 2026, the mortgage isn't what bankrupts you. It's the 2 silent assassins hiding in the escrow account. Assassin number 1, insurance. While you were watching interest rates, home insurance premiums in the US rose 20% in a single year. In places like Florida or California, try 100%. Insurers are leaving entire states. If you buy a house in 2026 and your insurer drops you, your mortgage lender will force place insurance on you. That costs 4x more. Suddenly, your affordable monthly payment is up $600. This destroys your debt-to-income ratio overnight. Assassin number 2, the tax reassessment. Local governments are broke. Commercial real estate has crashed, so cities are losing tax revenue. Guess who makes up the difference? You, the residential homeowner. In 2026, expect aggressive property tax reassessments. If you buy at the top of the market, you are locking in a tax bill that will rise, even if your home value drops. So, is the American dream dead? Should you live in a van? No, but you need to stop acting like it's 2019. Here is the contrarian playbook for 2026. Rule 1, the 5% rent rule. Take the price of the house, multiply by 5%, divide by 12. If you can rent a similar home for less than that number, do not buy. Right now, renting is cheaper than buying in 90% of US metro areas. Take the difference, put it in the S&P 500. By the time the housing market unfreezes in 2027, your stock portfolio will likely outperform that home's equity. Rule 2. Geography arbitrage. If you must buy, stop looking at the Sun Belt. Look at the Rust Belt. Places with stable climate, low insurance risks, and boring prices. The boring markets will win in 2026. The FOMO is designed to make you poor. The data shows that 2026 is a year of correction, not crash. Prices will drift lower. Inventory will creep higher. The freeze will eventually thaw. Cash is king right now. Protect your credit. Wait for the insurance crisis to settle. And remember, a house is a place to live, not a lottery ticket. If you want to know exactly where to put that cash while you wait, watch this video on the lazy portfolio next. It's beating the housing market by 8%. Thanks for watching.